Trading FX is brutally hard. Most retail traders lose money. This isn't due to a lack of capability, but rather because they're often playing the wrong game, unaware of the market's true dynamics. However, with the right expectations, defensive tactics, and realistic, testable edges, retail traders can significantly improve their odds. This video will lay out what retail traders are truly up against, why classic chart patterns often fail, and where practical, testable edges may still exist. Beginners in FX trading often blow up their accounts. Strategies can be invalidated by a single central banker sentence or large-scale institutional rebalances. Clear technical patterns are often just surface ripples over deep capital flows, macroeconomic forces, and sophisticated institutional positioning. When buying euro to US dollar, a trader expresses a view on two economies. Retail investors should recognize their place in this forecast pecking order. The interbank market is at the top, then institutions, with retail at the bottom. Retail chart prices are often just exhaust from larger engines. These larger engines include central bank policy, rate differentials, global flows, fundamentals, and risk or liquidity cycles, which truly drive currency valuations. Retail FX is effectively a betting market via contracts for difference, or CFDs. There's no central limit order book, so broker prices may vary. Furthermore, limit orders often behave like triggered market orders with slippage, and some brokers apply last look practices. The combination of high leverage, inherent volatility, and broker execution control collectively stack the odds against the individual retail trader. Unlike equities or bonds, currencies don't offer an inherent long-term risk premium. A currency's rise is always relative to another. This means consistent returns usually come from active trading, making FX a zero-sum game before accounting for costs. Losses usually stem from structural disadvantages, not a lack of intelligence, including excessive leverage, overtrading, and information asymmetry. An education gap in core FX economics also contributes to poor decision-making. However, adopting defensive maneuvers can significantly help. These include choosing well-regulated brokers, sizing small and diversifying positions, slowing down holding periods to days and weeks, and being skeptical of backtests that can't fully model spreads, slippage, and swaps. Some capital flows are forced, not profit-seeking, such as pension rebalancing at month-end, corporate currency conversions, and similar mandates. These create predictable, if sometimes noisy, pressures in the market that astute traders can identify and potentially leverage. Certain conditional premia show up consistently around specific business hours. Data often reveals foreign currencies appreciating versus the USD during US trading hours. Risk-off currencies like the Swiss franc or the Japanese yen tend to strengthen into week's end. While noisy, these patterns are often reputable. The classic carry trade, going long high interest rate currencies and short low interest rate ones, has worked in aggregate over time. However, it comes with a nasty negative skew, meaning large, infrequent losses. Broker swap markups can also eat into potential returns. Seasonality can be systematic. The Japanese yen tends to strengthen into the March fiscal year-end. Commodity-linked currencies exhibit calendar patterns, and even niche drivers, such as New Zealand's milk production cycles, follow similar patterns. Individually, these edges may deliver modest Sharpe ratios, but combined and diversified, they matter significantly more than a single Holy Grail strategy. Liquidity peaks during the London, New York overlap, causing spreads to tighten. Conversely, they widen in thinner Asian hours, especially around news releases. Timing matters immensely. Entering the pound sterling to US dollar market in Asia can result in 3 to 5 pip spreads versus less than 1 pip spread during the London session. While lower costs aren't an edge themselves, they are crucial for protecting good ones. Therefore, trade when conditions are cheaper. For retail traders, the practical playbook involves focusing on uncompetitive games, noisy flows that big money won't chase. Adjust your expectations. In FX, a Sharpe ratio of around 1 is a huge win. Build multiple uncorrelated systems, incorporating carry, seasonality, mean reversion among similar risk pairs, and treat FX as one slice of a broader, systematic portfolio. Use leverage to be capital efficient, not reckless, and always maintain sufficient margin buffers to manage risk relentlessly and effectively. In conclusion, FX trading is challenging and structurally unfair to the unwary. But with realistic expectations, defensive execution, and several small testable edges traded together at a sensible size, traders can survive and even thrive. Be humble, trade broadly, slow down, and manage risk relentlessly. Embracing these principles alone puts a trader significantly ahead of most in the foreign exchange market. If you found this useful, please give us a thumbs up. Share this video and subscribe to the FXEmpire channel.